Good afternoon, everyone. We're very excited and happy. I got right next to me, Rick Sanchez from Guaranteed Rate, an excellent lender, quality, quality consultations on your clients, on borrowers, the right plan. He does specialize in a lot of different products. But today we're all here for the newest product that's from California. It's called the Dream Home Ownership Program, or the shared appreciation type of a mortgage product for clients. I'll let the pro and expert talk about it with Rick Sanchez. Um, you guys all have your lunch already? You guys are good? Awesome. You guys are taken care of? Rick, you have the floor.
Thank you. Thank you, everyone. Yeah, scoot this over and then Zoom. If I am not loud enough, please let me know. I'm happy to speak up. But thank you, everyone, for being here and for attending, for having a lunch with me. I appreciate it. What I wanted to go over today is a very popular program. It's called the California Dream for All program. So I hear a lot, at least on the lender side, with the realtors that I know it's been very popular. I'm going to talk about the program, how it works, the details, but I wanted to take a little different spin on it and explain how it's not only for really like the low income first time home buyers. And so we'll share about that. So again, my name is Rick Sanchez. I work with Guaranteed Rate. If you guys don't know who we are a top 5 retail lender, very, very big mortgage company. All we do is mortgage. We're called correspondent lenders. So we have our own processors, our own underwriters. So we have the ability to make sure that the file moves quickly. We also have the ability to actually broker out loans. So we have about 40 different lenders in-house that we can underwrite to. If none of those is a solution to your buyer, to your client, we can send it out, and those are actual brokered loans. We have over 500,000 happy customers. We like to think of ourselves as a mortgage company that's built for realtors, for agents. So we were the very first world digital mortgage application. Actually, the application for your buyer is so easy, you could do it on your phone. We just rolled out what we call same-day mortgage. So if they apply early on and they, of course, qualify for this same-day mortgage, they could get a clear to close by the end of the business day. It would just be pending an appraisal, of course. Very flexible lending options. So we have the cookie cutter, right? The traditional Fannie Mae, Freddie Mac, the regular mortgage loans. We have the government loans, the VA, FHA loans. We have the jumbo loans and the super jumbo, so up to 10 million and an exception above that as well. What I specialize in is the non-QM loans. So these are for business owners, real estate investors, or foreign nationals. So if you have like an I-10 client or someone who's a foreign national and wants to buy here, if you have a business owner that on paper tax returns doesn't generate enough income, we have bank statement loan programs for that. And we just got one of our internal investors, and the rates, I'm not kidding, it's like the best in the market right now for bank statement programs. Renovation loans as well. And lastly, we have, we're a lending company, right? So we have home equity lines of credit. Your client can apply online and they could literally have the funds in their account in as little as 5 business days. The other thing we just rolled out is personal loans as well. So for those that have high debt and they need to pay off their debt to qualify for a bigger purchase, this is something that we could use as well. All right, so this is what I'm here for, and I wanted to talk about, which is the California Dream for All program. So as you guys know, the California Dream for All program is a shared appreciation loan, which is for your down payment and your closing costs. And this is for first-time home buyers. When they sell or they transfer the title of the house, this home buyer assistance is due, so they have to pay it back. Plus, they also have to share a portion of the appreciation of the home. Okay, so it's for first-time home buyers. That assistance is an actual loan. It sits on a second lien position, and it is due when they sell or the title is transferred. I'm going to share this quick video here. Zoom, if you can't hear it, I apologize. So I'll explain it here. So let's say that your buyer finds a $500,000 home and they use 20% of the shared appreciation, which is $100,000. They would then need a $400,000 mortgage loan. So they did not have to put any money down. And now assume that in 5 years, they want to sell the house, and the value appreciates to 600,000. Okay, so they want to sell in 5 years. Now the value appreciated 100,000. All right, so that 100,000, if the client asks for 20% of the price, then they have to share 20% of the value appreciation. So the way the final settlement statement would look is they sold the house for 600,000. Let's say that the loan amount now is 370,000 because they've paid. They paid back 100,000 for the second loan, and then their portion of the share was 20,000, 20% of 100,000. So the client would net out 110,000. So in this scenario here, you can see that if they put zero money down for the down payment, they had to pay back what they borrowed, right? Which in this case was 100,000. In those 5 years, the home value rose by 100,000. So they had to give 20% of that. Okay, 20 for the loan, 20% for the loan, 20% for that. In this scenario, after 5 years, they still netted, over $100,000 of that equity. Before I move forward, any questions there? Did I lose anyone there?
What if they don't know? Like, what if they die and does that mean they never give that to them?
Yeah, so the loan is due when they sell, they transfer title, or upon maturity of the loan, right? So the first loan, if it's a 30-year loan, it'll be due in 30 years.
Oh.
Yeah. Yeah, you definitely can, but only once. You can refinance once and only to lower the interest rate. So what we call a rate term on the first. Yep. So let me get into the details about the loan program. So this is for conventional and high balance loan limits. So as you know, in LA, that's a pretty big loan amount. It's only for a primary residence. Okay. The combined loan to value, which this is a combination of the first mortgage that they get and the loan that they get for the Dream for All. We call that combined loan to value. The minimum is 70%. Okay. What that means is that they could get 20 from this program, and then they can bring in 10 of their own. So minimum 70%. The maximum combined loan to value is 105%. The way you get to over 100, right? Because if you put 20%, is that you can use this with a community second. So for example, I know that in Pomona, the city of Pomona gives assistance for down payment as well. So they could use this for that as well. Okay. Normal loan origination fees, like any other loan, right? The lender will charge that. However, most lenders will charge points. Okay. In my scenario, I can't speak for everyone at guaranteed rate. The way all of the scenarios I've been running, for me, it's going to be about 0.95 of a point. So just a little under 1 point. Okay, so that's full transparency. You guys, can tell your potential buyer, yes, there are closing costs, right, with this loan program. The down payment assistance portion, again, it is a second lien, it's a second loan on the property. The buyer could request up to 20% of the purchase price or the appraised value. So whatever's less, right? That up to 20% can be used for down payment. It could be used for closing costs and for prepaids. It cannot be used to pay down debt if they needed, to pay down debt to qualify. That second, again, loan is at a 0% interest, so it's never going to, add up any interest on that. And it's due at the sale of the home, transfer of the title. So if they refinance, they don't do it correctly, right? That could trigger it. If they transfer it into a trust, that will trigger it, right? Or if they just move themselves out of the title, that will trigger it. And the maturity of the loan. So if they get a 30-year loan, 30 years later, when they pay off their first mortgage, that money is due. Okay. And then, Calvin.
I know it's geared towards first-time home buyers, which is defined as not have purchased in the last 3 years.
Yeah, so as a first-time home buyer, the way they view it is that you cannot be on title on a primary residence for the last 3 years. Okay, so I'll give you an example. You could be a renter and you could have a rental property, an investment property, right? And you've been a renter for 3 years, you would qualify for this. Also, your spouse can't be, have a primary residence, you live with your spouse as that primary residence and the loan is under his or her name.
Our situation. Go ahead.
Well, that was my question. I think you answered it. I have a client that just married. And I was looking to see if she owns, but her husband now married, and see if he can qualify here.
The key thing is where they live. Do they live in the new, right? You said the wife
They live
owns?
right now, like he moved in with her and want to sell the condo.
Yeah, that disqualifies him because now he resides in that property. Yeah,
But if they are showing to the lender that it's in escrow,
right.
will that justify that this will be the?
That's tricky, right? I don't know. The short answer is I don't know because if you can show that your client has not lived there for 3 years, right? He meets that requirement. I'll have to double check on that. That's a good one. It's a good scenario. Yeah. As far as the property requirements, this is for single family residences. So 1 unit residence, but ADUs are eligible. So if a property with an ADU, it would be eligible. It's good for manufactured homes and condominiums as well. Okay. And then, any questions on the down payment or property?
I have one more question.
Yeah.
So I have another client that husband and wife. The husband is on an item, the wife is not.
Yeah.
They qualify.
So,
They file together.
yeah, so this follows the Fannie Mae guidelines, right? So under the Fannie Mae guidelines for income, we could only use the one that has documented income. So the wife,
Right?
well, it would be the wife. We can't use I-10 income for this. So if she qualifies on her own, yeah, it's okay. Sorry, I saw a hand over here. Okay, sorry. Yeah, that's okay. They can own properties as long as where they live, their primary residence, they do not have ownership in. over the last 3 years.
So there are two other properties on land or
No. So it really is, what matters is where they live.
The 20% down, so they don't sell it, they don't need to pay back, or they have the limited time to pay back.
If they don't sell it, right, 30 years from now, they'll pay off their first mortgage, then it's due.
At that time, have to pay.
Correct.
Most likely they're gonna refinance before then.
Yeah, most likely they will.
Yeah, but they don't need to pay the short time,
Right,
at least 30 years.
correct.
what if one first time buyer gets married and with that vesting causing?
So if they get married and they already own the house through Cal Dream, right? Then just don't touch the title, right? The new spouse should not go on title of it. Because once they do, it triggers that event.
So I can't become a community.
Automatically community property after 2 years,
Yeah.
okay?
So it'll get messy at the divorce. Yeah. Okay.
My question is, and maybe you haven't gotten to it yet,
Uh-huh.
but let's say they give you the 20%
Uh-huh.
down payment assistance. How much appreciation do they share? It's the exact same ratio.
Yeah, it's the same ratio unless they are considered low income. So we'll look at that right now. Yeah. So the shared appreciation, we talked about when it's due. And the appreciation is from when they buy the house to when they trigger that payback event. Right? So sale of home, transfer of title, or when they pay off the loan 30 years from now. The amount that they share is the same percentage that they requested. So if they requested 20%, they would share 20% of the value appreciation. If they requested 10%, they only share 10% of the value appreciation, and so on. And then lastly, there is a cap on the total amount of appreciation that they have to share. And it's 2.5 times of the loan amount. So if they got 100,000 up front, 30 years from now, they never did anything right, and now it's due, it's capped at 2.5% of 100,000. So,
I got a question in regards to a home that is purchased and then homeowner decides to build or do additions, stuff like that. That money they use for construction count as equity for the resale when you sell 6 years.
yeah, no, it doesn't. It's strictly, yeah,
Yeah, if they build an ADU and they spend $500,000 on it,
But the value goes
and then
up.
they resell it for $2 million, yeah,
Right.
they don't get. They would probably reach the cap.
Mhm.
Whatever their money they reach, they're gonna be 2.5%
Yeah.
times.
it's
That would
gonna
be the
be,
maximum payback,
yeah.
or 20% if that's 20, whatever's greater.
Okay, anything else on this slide before we move on? All right. So the borrower requirements, first time home buyer, we've talked about that. They have to occupy that home as their primary residence. Non-occupant borrowers are not allowed, so I can't help my cousin qualify, right? Minimum FICO is 680. Minimum FICO is 680. Debt to income ratio is up to 50%. The maximum income, it's different for every county. Here in LA County, the maximum income is 180,000. But I want to take a quick moment here. That is very important because it's 180,000 of qualifying income. Okay. So if you have a client that has a salary of 180,000, right? But they make $200,000 in commission. Now they're at 380, right? And on top of that, their spouse makes another $100,000. Now they're like at 480, right? So they still qualify. If we can only use 180,000 of their base salary to qualify for the loan, we don't care about the bonus, the commission, right? All the other stuff. So that there, for me, is key. Because sometimes we talk about down payment assistance programs and we think of low income, right? Or we ask our buyers, hey, how much do you make? And they say, well, we made $500,000 last year. Well, let's take a moment. Let's see how you got to that figure. Okay, so any questions on that? Okay, so base salary is what we use, so the qualifying income. DACA recipients are eligible for this, and the borrower does need to complete 2 trainings before closing. One of those is there is a fee for that, but 2 trainings. Any questions on that? Okay. And then now we were talking about borrowers who have less than or equal to 80% of the area median income, right? AMI. That's what we consider the low income programs, right? So you look up where they're going to buy the house, you see what that figure is. I looked up Temple City and it's $78,320. If your client qualifying income is $78,320, okay, and again, it's qualifying income. They could make $200,000 of commission, salary, but it's qualifying income. Then their loan to value could go up to 105,000, and they do have a lower rate, right? They do have a higher debt to income ratio. So there's little perks for buyers who are under that 80% AMI. The fine print is what we were talking about refinancing. They can only refinance once, and it must be a rate term refinance. No cash out, right? It's only a rate term refi. That second loan, I abbreviated DFA as the Dream for All second loan, is due in full, even if the house value went down. So let's say that they sell in 5 years, the value went down from what they bought it for. They still owe that first, that $100,000 if they got 100,000. Obviously, the shared appreciation is not there, so they don't have to worry about it, right? Because the value went down. But it is important to know that they do owe it in full.
Can you explain it again? So if they bought it for 5, they borrowed 100 for the second.
Yeah.
3 years from now, value go to 450.
Yep.
They sell.
Yep.
You still have to pay back the 400.
They still have to pay the full 100. The difference, yeah. So. Good. Title needs to be vested as individuals and all borrowers need to be on the title. So I kept going back and forth with Calfa because I was asking if they could vest in the trust. And right now the answer is no, although I got mixed answers there. So I'll get back to you on that. I know that as a family man, I have children, my wife and I, for our residences, we like to have our homes in a trust. That might change in the future, right? And if it does, I'll let you guys know. But for now, individuals, all borrowers must be on title. Okay. And last thing we talked about, no non-occupant co-borrowers. All right, so this is kind of before I move forward about the programs, the details, anything that you guys have any questions on?
How much power does the second state have on the influence of the decision of the sale? I'll just give you an example. That yes, the second I want to pay off, and you talked about selling it for less.
Yep.
So in that same scenario, let's say I choose to sell it to something like a niece or nephew for below market. Do they have control over that?
They do, because they will look at what you sell it for, right? So not only the value of the home, but what you sell it for that specific scenario. They will look at the value. So when you buy a house and you ask for 20% of the purchase price, they're going to give you 20% of purchase price or appraised value, whatever's less. When you sell the house in a situation like that, they're going to look at the price that you sell it for to your niece or the value, whichever is greater. So most of the time, when you sell a home to someone who's not related, price equals value, so there won't be an issue. But in a situation like that, there would. Yeah. Any other questions there? How about in Zoom? Any questions? Okay. All right, so here's what I wanted to go over. I kind of talked about it in the beginning, right? Which is the reason why I like this program so much is because I don't view it just for low income buyers or buyers who have zero cash and they want to buy a house, right, with no money down. So I'm going to give you some scenarios of what I thought of and why I started calling a lot of my buyers, my pre-approvals that decided to not move forward, right? So I'll give you some scenarios here. The first one is the buyer has high income but low savings, right? It could either be because they just finished, medical school, or they got a great job now at Google, whatever. But it's client with a high income, low savings. In this scenario, this buyer has little cash, $50,000. They have high income, $180,000, and they have low debt, monthly debt, about $500. Under a normal loan, I would have qualified this client for a max purchase price of $715,000 with 5% down. That loan would have PMI. And the buyer would use all of their $50,000 for the 5% down, the closing costs, right? Under California Dream for All, what I would recommend is for them to ask for the full 20%. So they would put 20% down. The max purchase price would be 1.1 million. No PMI, right? Because they're putting 20% down. The buyer would use about $22,000 of their savings for closing costs. And they would keep some money in the bank, right? 28,000. So this is how my brain works, right? Like this is how I think. This is not just for someone who can't afford a home or has zero money in the bank. My brain goes, how can I get more buyers in a dream home, right? So that's it.
Already the buyer, she just finished the school, she is a doctor,
Mhm.
but she doesn't have any down payment. She can get the gift from the parents.
Yep.
And this is the 715 is the maximum amount for the
Yeah.
purchase price or for the loan amount.
So the 715, what I assumed here is that this person didn't have a gift, right? No one could gifted them 20% down. And so that was my assumption, right?
If you have a gift letter that brings you to a 10% or 20% down, then the PMI, 20%, the PMI will remove.
So if she doesn't want 20% borrow, just for that amount for down payment,
Mhm.
it should be fine too.
Yeah. And yep. So you could ask for 5%. Let's say you have 15% of your own money. You're trying to avoid PMI. Just ask for 5. Yeah, you can do that. You can ask for anywhere from 0 to 20. Another scenario is that the buyers have debt that is preventing them from buying. So I see this a lot, right? So their monthly debt is too high and it's preventing them from buying. So in this scenario, my buyer has little cash, 50,000. They have okay income, 125,000. So, okay.
So did she have been in the job how long?
So yeah, there's Fannie Mae requirements, right? You have to have a 2-year history of that same employment.
No, like right now, she just finished the doctor's.
Yeah,
So she just get in like a walking. So
yep.
how long have you been working?
Yeah, so when you're employed in a scenario like yours, you just show that prior to that, they were in some schooling, some trade, right? And that eliminates the 2-year employment history. So in this scenario, it would be buyer has little cash, they have okay income, but they have a lot of debt that is preventing them from buying. Under a normal scenario, I priced it out, it would be a $500,000 purchase price. They put 5% down, they have PMI, and they use all of the $50,000 for the down payment, for the closing costs, and to pay down debt, right? Under this same scenario, what I would do, what I would recommend with the California Dream for All is I would have them ask for the full 20%. 17 of that 20% would go towards a down payment. 3% would go towards the closing costs. Okay, and then the rest of the 50,000 would go towards paying off all the debt. Because this DFA loan, right, Dream for All loan, you cannot use it to pay down debt. You can only use it for down payment and closing costs. So now let's kind of like sit down and let's put this puzzle together, right? Like, how can we make it work? And then that's how I would do it. Their payment would be, comparable, if not a little bit lower than a $500,000 home because of no PMI, better rate, and so on. Okay, so I'll zoom 3. I have 2 more examples. Here's one that buyer has 0 cash and makes too much money for a down payment assistance. I run into this a lot, right? Especially out here, home prices are pretty expensive. Where if you look at the AMI for Temple City is 78,000. So if you make more than that, you don't qualify for a down payment assistance program. So historically speaking, that's how it's been. Under a normal option, if someone has 0 cash for down payment, they make high income, 150,000, and they have low monthly debt, no options, right? Because they don't have down payment. Let's assume that they don't have someone to gift them money, right? They just can't buy. So what we do is we tell them, okay, just go ahead and start saving money. Get to the 3% for, a low down payment or an FH. Any questions on a scenario like that?
Is the AMI based on where the leasehold is?
Yeah. Yeah, subject property.
Great question for the rates. What is it?
Right now for this program, today was 6%. Remember, you can refi once. And that's the key, right? Whoever they go with, they need to trust their lender that they're not going to refinance too quickly. Because once you do that, you're done, right? So if rates continue to go down, you just have to be careful with that. A scenario here is a buyer can't find a home they like in their budget. I get this a lot too, right? They qualify for a house, but they just don't like the houses that they qualify for. So in this case, the buyer does have cash. They have $100,000, good amount of savings. They have okay income, 125,000. This is an exact scenario of one of my clients, by the way. And they had low monthly debt. So they had a lot of savings. Maybe it was a gift, but they have it. Okay income, low monthly debt. Under a normal loan, they would qualify for a $720,000 purchase price. Under the California Dream for All, they would qualify for up to $850,000. So this person just got, $130,000 more of a purchase price. The way I would recommend it is because they have that 100,000, I would say get the full 20 for the down payment, bring in 10% of your own money. Now you're putting 30% down, right? No PMI. And, you're going to get yourself into a much bigger house or more expensive house. It's not custom. No PMI, it's an extra expense on a monthly basis that is not going towards your loan amount. So you're paying insurance, that really is it. An extra expense. Any questions on this scenario?
So, especially the monthly payment that will be calculated from the 80% and 20% together, or?
Yeah, good question. So if you get 20% from the DFA,
Right.
and you bring an additional 10%, now your loan amount is a 70% loan amount, right? So essentially you put 30% down. So your payment's gonna be lower.
But the 20% is that you don't pay the monthly payment.
No monthly payments, no. No monthly payments, no interest. You only have to pay it back, you know,
Until
when
you sell.
sell,
Yeah.
transfer, or you pay down the loan.
And how long will it last to get a waive of the 20% assistance? And how many years to have that waive, you know?
So you don't waive
It's
it.
never wait.
Yeah,
You're paying it back
yeah.
In 30 years or when you refinance.
Mhm.
But you think about it, the way I would present it to a picture to a buyer. You're basically having an investor giving you money. The state of California is your partner in this purchase.
Yep.
And they're gonna have, if they give you 10%, they'll be a 10% equity owner of only the gains, not the sales price, but the gains.
Right.
And it's like having a partner with you for the risk, but they get the gains.
Right.
But they're at the risk. If you sell it for a loss, they lost,
No,
not you.
Well, you have to pay back.
Oh,
the
you
loan.
pay back the original
Yeah, you have
amount.
to pay back the loan.
You have to pay the original amount. You're not paying the 2.5.
Correct.
Pay back the 100.
Yeah, you
You
do.
borrow 100, they're gonna get back 100. But normally in investors, they would want the equity too, or the appreciation, or regardless of you sell for a loss.
To piggyback on that, right? Because sometimes when I pitched it to some of my buyers or maybe some of my agents, initially they think like, ah, man, I have to share the appreciation, right? Like, that doesn't feel right, or I'm gonna owe this money. The way I like to think about it too is that in the past, you had to come up with 20% down, right? You couldn't buy a house unless you had 20% down. But then lenders got created and said, okay, give us 10. But then you pay a mortgage insurance, right? And then other lenders said, okay, give us 3%, but now you're paying a higher rate and it's the same thing, right? Like you borrowed more money from someone to go into home ownership. Same concept. You're borrowing money from this fund to go into home ownership. All right, last scenario here and we'll be finished. This, the buyer says that the payment is too high. So I get this a lot too, right? They have the down payment, they have the income, they have the credit, but right now the payment is too high for them because of interest rates or maybe because of the purchase price. And I get this a lot. The people tell me like, I'm just gonna wait until values go down because my cousin told me that, you know, prices are gonna go down. Or I'm gonna wait until the interest rates go down. In this scenario here, same purchase price, 750,000. This person put 5% down. They had PMI, their monthly payment with taxes, insurance, PMI, you know, the loan is $5,728. And they use their full $50,000 for the down payment, closing costs. Same scenario, this person said, you know what, Calvin, 750, I like the house, but $5,700 of a payment is too high for me. I'm gonna wait until the interest rate goes down, or I'm gonna wait until the prices go down. My recommendation would be go with the California Dream for All. Ask for a 20% down payment loan. You're gonna get a lower rate than you would have gotten. Your total payment would be $4,512. So about what, $1,200 less for the same home. No PMI. Your buyer uses their savings for the closing costs, and on top of that, they still keep some money in savings, right? Because they didn't need it. So now I go back to my pre-approvals and I say, remember that time you said payment was too high, you wanted to wait? I got a solution there, right? And then if you guys want to, I'm happy to do this for you, but if you want to show them the numbers of tomorrow. So if you guys ever need an analysis like that, I'm happy to help. Any questions, you guys want to have these conversations? I know sometimes when we throw numbers at clients, it gets a little confusing. I'm happy to help you guys in any way. Yeah.
The next house is for their home.
If they take the full 20%, the maximum the borrower can buyer can bring on their own is an additional 10. So 30%.
For that same scenario where the buyer wants to wait, we don't like that as agents. We want to do a transaction today, correct? Here's one great piece of advice I can say is, sure, you could wait for rates to cool down. I guarantee you rates should be lower than 6.5% or 6 in the future at some point or time in the other, but we don't know that. It's unforeseen. It could be 2 years. It could be 10 years. We don't know when rates will be under 5% again. But when they do, if they do, and eventually, if you wanted to keep renting for 5 more years, that's fine. But think about this. If the climate becomes favorable for borrowing again, and don't you think other people would like to buy too? Remember what happened during the pandemic in 2021 and 2020? Even if you wanted the home, you couldn't get it because there was a line out the door. There's 200 people at the open houses. And when rates are favorable, there's 30, 50 offers on the property, like there was when we had a listing on the pandemic period. So even if you wanted to, you won't have the agreement from the seller, and you're going to be stuck wasting also energy and resources and time writing offers on 20, 40 different homes and getting rejected on most of them. Yes or no? So if you're in the business and you use practical examples, things could make sense to hopefully get them to do a transaction today, which is, good for all of us. But this program is special. I do think it's something that's another unique way for you to go out and reach out to all the borrowers, whether they're renters or buyers or owners, I don't care. It lets you share something really powerful, impactful. Maybe they're not buying, but your client may know someone who could use this product too. And it allows you to have a healthy conversation. Shows that you're knowledgeable.
That's right. And whether, they make $500,000 in income or not, this is worth having a conversation, so I can take a look, or your trusted loan advisor can take a look at their income and see if they can fit.
Now, this is geared for buyers. How can this be useful to anyone who is a listing agent? If you're not thinking, how could this information be useful to a seller? Because a seller would not qualify to get this program. But guess what? A seller would be getting a lot more activity because people are more spend happy when it's not their money. So if a buyer who wants this and get this program, they're willing to write strong offers, above asking offers. And so you pitch it to your seller client, put the property on the market today. Many home Cal HFA buyers right now are going to be spend happy trying to get your home and giving you above asking because there's limited inventory. We already did your CMA. There's only 2 other homes and we're all going to get our sold above asking. Let's get yours on the market today so these Cal people can spend it. Right?
Yeah, it kind of goes to the scenario, right, where you have that buyer that can't afford or qualify for the home they really like, right? Now they have, in this scenario, $130,000 more to throw at a seller, right, to get that offer accepted.
Yeah. They'll be a little bit more aggressive when they're spending other people's money, the state. I would. Okay, but I'm disqualified. Okay.
Any other questions? Yeah.
And this is the first time buyer in this program, right?
First time home buyer. And remember, first time home buyer.
Has a different definition of what we think.
Yes.
The literal is not a first time home buyer. Okay. There is the
This was first time buyer by use this program buy the house cannot but some now can at the ADU cannot use your land, right?
Can they build an ADU? Is that what you're asking? After? Yeah, of course. As long as they don't. The thing is the title. Whoever is the on the title, the vesting of the title, they just don't want to change that. Okay, so when they go and they build an ADU, the owner, right, the title, the vesting, they don't want to get a renovation loan or anything like that that's going to touch the vesting of it. Oh, and one more thing on that. Sorry, miss.
What is your closing cost?
Yeah, so it's regular Fannie Mae loan, right? So you're gonna have your loan origination, your appraisal, right? Normal, right? On top of that, the lenders are charging anywhere from 0 points to up to 3 points, right? In my scenario, where I'm allowed to offer this loan and it makes sense for a guaranteed rate, right? Because we are a business, is to charge a little under 1 point. Mhm.
Plus another.
Plus a normal, whatever, you know,
Normal.
12, 1300.
No, that's in addition to. So remember, points is yeah. Mhm. So about 1 point. That 1 point can be paid through a seller credit. It could be paid through this loan program, you know? Ooh, good question. So there's 300 million allocated to this. I did the math. About average sales price in California, I think is 700,000, right? Divide 300 million by 700,000, it's like 2,400 transactions. Right? So it's limited. So let's say everyone takes the full 20% of 700,000. It's limited. But it's confusing. People are not viewing it correctly, in my opinion. You know, in my opinion, they're not. So in this case, you can do 30 or less. It depends on your lender. What we do, the only thing you should know is that we can't lock the rate technically until we get confirmation from them. Yes, we have your application. The funds are secured for this client. You can lock it now. So right now it's taking us about 5 days from when they go into escrow to be able to lock it.
So we can still do a 30-day escrow
Yeah.
proposal.
30 days.
In your scenario, let's say that in Kansas City, the borrower was limit income, under 78,000 money.
Mhm.
Based on the value property in Kansas City and the income, the buyer, it looked like it didn't work.
I know. I talk about that all the time, right? Like in Southern California, if you're making $78,000 or less, you're not gonna buy a house. You're not gonna qualify for it. So, yeah. Yep. But with this program, right? There is a way because now you're gonna put 20% down. So you will qualify for something better.
Any other questions?
We're just saying if we wanted to,
Right now, the answer is not possible, but I have a feeling that's gonna change because of the conflicting responses that I kept getting from them directly, actually. But I'll let you guys know if that changes.
Who's excited to go call your buyers on now and let them know about this? Huh?
Yeah, and if you guys have those buyers that payment was too high, the house wasn't pretty enough, whatever the case may be, give me a scenario. I'm happy to shoot what the program numbers would look like for them. Very easy, very quick for us to do. Okay, so I'm happy to do that. All right, thank you,
Thank you all
everyone.
for being here. Shimona, do you have any questions?
No, but thank you so much. It was very informative.
Thank
Okay.
you, Shabana. I appreciate
Thanks for
it.
being here. I'm
Thank
sorry
you.
it went in muting for a couple of times on its
Oh,
own.
Okay. Thank you. Bye-bye.
Say hi to Legend for me.
Okay, I will. Thank you.